Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Despite trade wars and continued political uncertainty presenting challenges for investors in 2019, it's been a strong year for investment companies. Industry assets reached an all-time high of £200 billion in July. October saw a record-breaking level of secondary fundraising, and the average investment company has returned a healthy 14% over the year so far. However, with Brexit hanging in the balance and concerns about global growth, there are certainly threats which could be worrying investors for 2020. To discuss the outlook for the year ahead, I'm delighted to be joined by Laura Foll, co-manager of Lowland Investment Company, and Bruce Stout, manager of Murray International. So Laura, what are the key reasons for optimism in 2020?
I think the main reason that I have for optimism is where we're starting from in the UK. So we're starting from a place where sentiment is very low towards the UK equity market. We're starting from a place where valuations are very low. This is versus global equity peers and also versus the UK's own history. I think that's always a very good place to start. And then when you look at the backdrop in the UK, and I'm talking at a point where we haven't quite had the election yet, but it's very close, we could have a situation next year where we have more political stability, we have modest fiscal stimulus boosting the UK economy, and that would in turn boost, I think, business confidence and consumer confidence. So I think what we could see next year in the UK is a modest year for economic growth. I'm not talking, stellar 2-3% growth rate. I'm talking a year where we have a more stable backdrop, perhaps 1.5% GDP growth. I think that's a lot better backdrop for UK businesses.
Yes, quite positive. How about you, Bruce? What are your key reasons for optimism next year?
Well, it's always difficult to encapsulate the whole world in an outlook, but I think one of the underlying features that is very positive is the interest rate backdrop. Now that the US has stopped raising rates, it's enabled a lot of countries around the world to start to cut interest rates because they hadn't up until this point. So we've seen rate cuts in Indonesia, we've seen rate cuts in Mexico, we've seen rate cuts in Brazil and also in India. So that enables growth to pick up next year. That's what we'll be looking to see, a pickup in economic growth in many emerging markets, which should be positive for the companies that we own that are domiciled there, but also, of course, for companies in other parts of the world that do business there. Well,
that sounds good. Now, what are the key reasons for concern next year, Bruce?
Well, there always has to be a fly in the ointment, doesn't there? And of course, the main issue this year has been protectionism. And as of just now, we haven't actually resolved that issue. It does seem to be very focused from the United States against the rest of the world. But we would really like to see some improvement in sentiment, because if we do see an increase in protectionism, everybody loses. You get lower growth, you get higher inflation, and it's certainly not good for equity markets. So let's hope that the protection issue can start to go away early next year and we can move forward from there.
Yeah, some sort of resolving the trade wars. Yeah. Laura, how about you? What are your concerns for next year?
I completely agree with Bruce that partly what keeps me up at night is no resolution to the trade war. In Lowland, we have around a quarter of the portfolio in industrials. So the outlook for that sector in particular is really important to us. So that's number one. But number two, the domestic UK economy is genuinely important to Lowland. If you drill down, we would have roughly 50% of sales exposed to the UK. That would be more than the benchmark, which would be roughly a quarter of sales in the UK. So the fate of the UK economy does matter. And so what would be a bad outcome for Lowland would be more political uncertainty, perhaps additional referendums. These are the things that I worry about for the portfolio.
Well, talking about the state of the UK economy, how are you approaching Brexit uncertainty in your portfolio?
I think what I've learned over the last 3 years is don't try and predict the outcome, because there have been so many twists and turns along the way. We've had multiple prime ministers. At some points, it's looked like there's going to be a second referendum, and then not. I think what I've learned is that I will never get it right. I'll never be the first to know. So just focus on valuations, and where valuations are pointing you and have been pointing you for some time is domestic UK. There is a clear valuation discount among those companies that are more exposed to the domestic economy. So where we've come out is, we don't know how this is going to be resolved, but we pick companies that are attractively valued, and really importantly with experienced management teams that will be able to deal with anything that comes their way with regards to Brexit, because realistically we don't know the outcome.
Well, definitely not. I think we're on our third deadline for Brexit now, so it's definitely been going on. Bruce, back to the trade wars, Trump's trade wars. I'm interested, what impact will that have on your portfolio and investor sentiment, you think, in 2020 and going forward?
Yeah, the trade wars could become a very complex issue. At the moment, or certainly up till now, we've seen it very focused on the sort of US-China basis, but it has spread more recently to certain types of products, which is not a very good development either. I guess one way that you can protect yourself against an escalation in trade wars is to focus on domestic businesses in economies in which you invest. So, for example, household products in a place like Indonesia or retail in a place like Thailand is not really going to be impacted by any development in trade wars. So that's one way of doing it. But there is so much uncertainty if it were to escalate that it's very difficult to protect yourself against it.
I mean, we do have an election in the US, of course, next year.
Yeah, we do. And a very interesting point, really, to mention that, because up till now, it really has been one person's crusade in order to develop these trade wars. It's not really a policy of Washington. It's certainly not within the Republican Party to want to hurt the commercial interests of US companies abroad. But that one person has delivered trade wars and protectionism during the last couple of years, and therefore it's pretty much centred around him.
Absolutely. Well, one to watch then.
Definitely.
Now, Laura, what is most important for your investment company in 2020?
I think realistically the fate of the UK economy is by far the most important factor, and in particular what happens to sterling. Now, unfortunately, if you'd gone back a few years ago, the performance of Lowland would have been correlated with sterling, but nowhere near to the degree that it is now, which is a factor of how sentiment is swinging so strongly towards domestic UK. So realistically, what matters, and as frustrating as that is as a bottom-up stock manager, I think what matters for Lowland is what happens to the UK economy, what happens with the political outlook next year.
I mean, we have seen sterling a bit stronger recently.
Exactly, and that has been really quite beneficial for performance recently, because and I think what that's reflecting is the prospect of a hard Brexit seems to have gone out. I don't know what would happen at the end of next year. I'm not saying that prospect has completely gone away, but it seems more likely than it did, say, in August time. And that's why sterling has picked up and the relative performance has picked up recently.
Great. Bruce, what's most important for your investment company in 2020?
Well, we've talked a little bit about the interest rate backdrop and how that has most definitely improved in the year just past. So if the baton then goes from interest rates, it normally goes to earnings. And I think in the last few years, where growth has been slightly lower than expectations in the emerging world and in Asia, because interest rates have had to be higher because currencies have been weakened by the trade war. What we'll be fascinated to see next year and beyond is the sort of operational leverage and gearing that many of the companies that we have and own in the trust, what it's like to accelerating growth. Because we know the balance sheets are in good shape, we know the costs are in good shape, so if the top line starts to grow higher than expectations, then it could be very interesting indeed for earnings growth in many of the companies we own that are focused in Asia and emerging markets.
Excellent. Let's hope that happens then. I'd like to thank you both very much for joining us today. It's great to hear your views on the outlook for 2020, but I'd like to emphasise we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. All that remains is for me to wish you a very Merry Christmas and a Happy New Year. Thanks so much for watching.